if someone says, here, here's an assumable loan,
Okay.
What are some?
Simple. You're going to get the loan term sheet that they have. I mean, the loan that they have on the property right now. And you're going to need to see the interest rate. When is it maturing? What's the amortization? And the key is to know who is the servicer, who was the originator of the loan. If it's Arbor, it will have to go through Arbor. Whoever originated the loan, these are the people that have to do the assumption process. So if the rates are good, whatever the terms of the loan that you get, you put it in your calculation, in your numbers, and then you underwrite the deal based on what they got. It's simple.
Based on what they got.
It's like you're taking over a loan. So you're taking the property at 4.5%. There's 3 years left in the fixed rate. And then you need to just find out what's going to happen after that. Is it going to be rolling into floating rate? What's the situation with the prepayment penalty? Is it a step down or yield maintenance? That's very important because it's maturing in 3 years and suddenly you want to get rid of that loan. You want to make sure that you're calculating how much would it get to get out of this if you want to refinance it again.
I'm sorry, my question is getting into an assumable loan. What are you looking at as far as making the seller whole?
That's important. It's a good question. Typically, when you look at the assumable loan, the loan balance would typically be, let's say, 70% of what they paid for it. That's a very good question that you brought is because typically with assumable loans, it's more heavy on the capital that you need to bring. You see?
Got it. So what I'm trying to understand is there's a delta between what is actually owed and what they want.
Yes.
And we negotiate in there.
Yes, but the delta will only be able to shrink up to a loan to value that is according to the loan. So if the loan is a Fannie Mae loan at 70% loan to value, the delta would shrink for 2.5. It could only shrink to 2 million, which is what they paid for it, because that will be 70% loan to value. You understand? But it's likely that they're not going to, unless they're distressed, they're not going to sell it for what it owes them or what they paid for it. And more often than not, they spend more money on it from their own capex, so the delta is already going to be even bigger. Assumable loans are very often actually more capital intensive when you take the deal on because they have to meet the loan to value and there is a profit margin on top of that for the seller.